Wells Fargo cutting credit is only the tip of the iceberg, but is there real danger ahead? Well, last week, the retail financial world was shocked when Wells Fargo announced they were shutting down personal lines of credit, leaving many to wonder what was going on. Now, I've seen many commentators reading you the news story, which you can do for yourself, but they all seem to be really failing to grasp what this means, because to really understand this, you need to understand what's going on. You need to understand three other things: what happened in the 2008 Great Financial Crash, and more importantly, what happened in September of 2019 in the repo market crash, and even more importantly, what's happening right now in the reverse repo market today. So in this video, I'm going to break down what Wells Fargo did, what other banks are doing right now, the historical context of how this compares to the 2008 Great Financial Crash, and then we're going to look under the hood of the financial and banking system to see what happened in 2019 and today, to see if the Wells Fargo news is just an isolated incident or is it a big sign of what's to come, and of course, what we should be doing about it. So let's go. All right, now real quick before we dig in, if you're new to the channel, my name is Mark Moss and I make these videos because I want to change the way you think about money, because almost everything you've learned is wrong. And I know it's hard to navigate these markets correctly, and it's scary to think about what happens if you get it wrong. These are complex subjects, and I try to make them very easy to understand because these affect your money, your family, and your future. And so I try to make them really easy and actionable so you can be educated and knowledgeable about what's happening and coming in the future. So if you feel like these topics help me out, click on that like button. It sends the algorithm sends it out to more people. Hit the subscribe button and the bell notification if you're not already subscribed. And one more thing, just real quick before we jump in, I am hosting a live event where I'm going to dig into this deep. I'm going to tell you what's happening and some things that you can do. But if you really want to dig in deep with me, I'm having a live event. There's a link in the description. I'm going to pin it in the comments as well. You can sign up for free. We're going to dig deep into this, into my last video topic, the inflation and these cracks. I'll really tell you what I see happening, what I think is going on, and specifically what I'm doing and what you could be doing to protect yourself from this. So the link is in the description and it's also pinned in the comments. So check that out. It's a free event. All right, now jumping into this, like I said, the headline is that Wells Fargo is cutting credit. So like I said, that made big news. I've seen a bunch of other YouTubers talking about this, but they're just reading you the news story. You can do that yourself. What's really going on? That's what you need to know, and that's what I'm here to tell you. So the news is they shut down all existing lines of credit. They're still doing loans, right? There's lots of other loans, but they're shutting down the existing lines of credit. All of them, though, they're shutting them down. Now, they did say that this may have an impact on people's credit scores. All right, now we can see this. Again, I can read you the headline. You can read it yourself, but you can see here, Wells Fargo tells customers it's shuttering all personal lines of credit, shutting down all existing personal lines of credit in the coming weeks. So it's happening right now. It warned customers right here that the account closures may have an impact on your credit score. So if you're with Wells Fargo, your account's getting shut down, you need to be paying attention to this. I'm not gonna go into much deeper on that because like I said, you can read that yourself, and that's what I saw most of the the other analysts on YouTube reading to you. But just so you know, I said it's a strange move, giving the banking industry's need to boost loan growth. So this is the piece that we're gonna dig on. Why would they do this when, as they say here, the banking industry's need to expand credit? Really seems weird when they're trying to expand credit and they're shrinking it back down. After a burst of commercial lending during the early days of the pandemic, loan growth has been hard to muster. Loan growth, I'm gonna tell you what that means in a second. In fact, last year's big banks experienced the first aggregate drop in loans in more than a decade since we're recovering from the 2008 financial crash. After banks saw that borrowers held up far better than they had initially feared, the industry recently began marketing new credit cards with large sign-on bonuses in an effort to boost lending. So this is a time when they're trying to boost lending, so why would they be pulling back? Now, we live in a debt-based monetary system. The dollar is a debt instrument. Money is created through debt. So I talk all the time about the money printer. It's not really how it works. So the Fed gives reserves to the banks, and then the banks create the money when they loan it into existence. When you get a credit card, when you buy a car, truck, a house, RV, they loan you the money and that creates the money into existence. And so we need to constantly be creating new money. We have to keep growing. If we don't grow, we start shrinking. And so we do that through issuing debt. That's why these loans are so important, and that's why it's interesting to see. Now, let's jump past the headlines that I said you can read on your own, and let's start digging a little bit deeper. Now, what's interesting is it's not just Wells Fargo. So we can see here Jamie Dimon. Jamie Dimon is the CEO of JP Morgan. I'm sure you heard of that bank before. And he says they're hoarding cash because a very good chance inflation is here to stay. So Wells Fargo is not loaning out money either, and now JPM is also saying that they're also hoarding cash as well. We can see here JP Morgan Chase has been effectively stockpiling cash, that's their words, because of the possibility of higher inflation. We have a lot of cash and capability, and we're gonna be very patient. We have a lot of cash and a lot of capability to issue loans, but we're not. We're gonna be patient. Why? Why is that? That's what we're gonna look at. Now, the bank now expects $52 billion in net interest income in 2021. $52 billion, not bad, I'd take that. Down from $55 billion it disclosed in February. So it's going down. They're losing money as the firm stockpiled cash. So they're losing money from 55 to 52. It's $2.5 billion they've lost in lending out money because they've chosen to stockpile cash. Must be pretty important. It's probably something that you need to know about. So let's take a look at that. So first thing we're gonna do is we're gonna hop in the time machine. You know, if you watch my videos at all, we always have to pull the historical elements in because I believe that history tells us what we're doing, how we got here, more importantly, where we're going. We're not gonna go super far back. We're going back to 2008. Now, again, a lot of these other people on YouTube or wherever you're getting your news from maybe haven't lived through this stuff. Mike Tyson said, everyone has a plan until they get punched in the face. Well, I've been punched in the face. If you're a longtime viewer of the channel, you know my story very well in 2008. But I'm talking about the great financial crash, the GFC. The entire banking system was about to collapse or kind of did collapse in that time. And what happened is basically the banking system locked up. So the banking system locked up, there was no liquidity, there was no loans to keep them afloat. And then there was no loans to keep anybody else afloat, which is why everything started dropping like a rock. Remember, we're a debt-based system. So if we're not expanding the credit, then we quickly contract. And that's exactly what happened. And we saw that during that time. I have a couple charts for you here. New loans to large borrowers started to decline. As a matter of fact, we can see they fell 47%, so almost half. Loans dropped, half the loans. And as a matter of fact, they fell 79%. New loans were reduced by almost 80% from their peak, all right? And we can see this right here. This is total loan amount issued in billions of dollars. So we can see this is 2000, the year 2000. And we can see up to 2008. And then we can see the loans just fell off a cliff all the way back to where they were previous to 2000. So remember, the market grows as the credit expands, and when the credit contracts this hard, the entire economy collapses. We can see here the number of loans in red and the total number of loans went down like a rock all the way back to here, right? We can see that. A couple other charts that I want to show you here that I think are relevant just to show this point because you need to understand the history side. So here's non-investment grade credit went down, investment grade credit went down. Of course, the term loans and this is term loans in blue. The revolving lines, look at that, went down. Why revolving lines? Well, what did Wells Fargo say they're going to close? Personal lines of credit, the revolving line. Look how far those fell off a cliff. The reason why I'm showing you this is because I want you to see what happened last time they retracted all the credit, right? We can see restructuring loans went down here. Real investment loans fell down a little bit here. So that gives you the historical reference. You can see that when times get tough, when the banking system sees trouble, what do? They stop doing loans. Now there's more though, there's more. Now after 2008, they introduced quantitative easing, QE, right? We talk about QE a lot, quantitative easing. Basically what the QE is it's a way for the Federal Reserve. So the Federal Reserve has two tools. They have interest rates and they have the monetary supply. And that's a way that they can increase the monetary supply or basically inject money into the financial system. With QE, they do that. Now we can see here, I've pulled up this the press release. This is from November 5th of 2008, and the Federal Reserve announces it will initiate a program to purchase the direct obligations, all right, and that was quantitative easing. Just for an easy example, understanding of what that is, we can see what it is. Central bank purchases long-term securities from the open market in order to what? Increase the money supply. So they can only issue debt, so they do that to increase the money supply and, not just that, encourage lending. Remember, they need the banks to lend so they get that money out into the system. Lend to people so they can go buy more cars and more houses and more assets, right? So they do that, right? And it adds new money to the economy and also serves to lower interest rates. So lower interest rates, put more money in, get that economy stimulated and growing. Now, we can see that since that time, from crisis to crisis, the Fed's assets, here's 2008. So here's where it happened, the financial crisis, they increased their assets. But after the crisis was over, they didn't stop. As a matter of fact, they kept it going. Here's about 2014. And then times were really good until about 2019. And then we ran into a little bit of trouble. They started tapering. They said, let's just pull back on the amount of QE that we're doing. As soon as they started to pull back, this is a key piece, as long as they kept this artificial stimulation going, things were good. Here they decided to pull it back a little bit. Let's just taper a little bit. And the market started crashing. And what do you think happened? Of course, they started it going right again. Now, I'm always reminded of this quote right here. Milton Friedman, nothing is so permanent as a temporary government program. So QE was supposed to be temporary, but nothing so permanent as a temporary program. Let's look at that, what that means. All right, now, Wells Fargo is the tip of the iceberg, in my opinion. Now, going back to 2008, you can see what happens when banks start pulling back, or more importantly, you can see why banks start pulling back, all right? All right, now, as I said, I believe that this Wells Fargo news is only the tip of the iceberg. And the reason why is because, one, we go back to history and we can see why banks start pulling back credit and what that means for the bigger picture. But more importantly, because there's much deeper problems, much more deeper in the financial system, in the financial engineered system, and that's what most commentators are not picking up. And so what are these deep problems? Well, to really understand, we go back to September of 2019. Now, a lot of people saw the pandemic and the way the markets crashed in March of 2020, and they believed that it was all because of the pandemic and because we locked everything down. And you might believe that if you didn't know what happened in September of 2019. So at that time is when the repo market seized up. Now, I've talked about the repo market before. It's the repurchase market. And basically, it's the way the banks provide liquidity to each other overnight. So it's kind of like a pawn shop. So a bank wants to borrow money and they put up collateral. So I might decide to loan them the money and I take their collateral, which is usually T-bills, treasury notes. And so that's considered the best collateral. That's the government is going to pay me back. So I'll loan them the money, they'll give me the T-bills back, and that's how that works. Now, the repurchase agreement means that we have an agreement where I can repurchase it back, kind of like the pawn shop. I go pawn this asset, but the agreement is I can go back and buy that asset back from them, all right? And we saw that happen really, really quick. Again, if you were listening to this channel back then, you were caught up on it, but we can see here, this is again from the Federal Reserve, right here, dated February 2020, February 27, 2020, they said, what happened in the money markets in September of 2019. That's when everything started coming off the rails. Some people think that maybe the pandemic helped to cover that up, but this is where it all started, and we can see this got jacked through the roof. And so basically what happened in this repo market is that banks are loaning money to each other overnight with collateral, with the best collateral you can have. And so typically the interest rates are very low. But supply and demand says that if nobody wants to loan money, I have to be willing to pay higher rate. And I have to pay higher until finally somebody would take that. Well, that's exactly what happened. On the morning of September 17th, 2019, interest rates on overnight repurchase agreements, or repos, were a short-term loans between financial institutions, right? Back and forth. But they experienced a sudden and unexpected spike. So check this out. Secured overnight financing rate, the SOFR, S-O-F-R, increased from 2.43% on September 16th, and they reached as high as 10%. So they went from 2.43 on a secured loan to 10% because nobody wanted to loan money. Of course, the entire banking system froze up because nobody would lend money back and forth. So what happened? The Federal Reserve came to the rescue. Federal Reserve jumped in and they injected $75 billion in liquidity in the repo market on September 17th and continue to do so every morning for the rest of the week. Now remember that number, 75 billion. This is the interest rates. You can see them jacking through the roof. Nobody wanted to lend to each other. So the Fed came to the rescue, injected 75 billion, okay? That's what it took to free it up at that time. But look how fast it went off the rails. This is by March of 2020. New York Fed pledges to offer 1 trillion a day. So from 75 billion to 1 trillion. And that's how bad and how fast things went. The Federal Reserve said it will make up to 1 trillion a day available for loans in the repo market. The latest efforts from the central bank to keep markets operating smoothly, basically so they don't freeze up, they don't seize up like they did in 2008. The Fed said it would reinstate the funding facility need during the 2008 financial crisis to get credit directly to the businesses and households. See? Like in 2008, the credit markets froze up. They stopped doing loans. The same thing happened here. They went from 75 billion a day to $1 trillion a day, and the Fed said that they would do the same thing, the same financial facilities as they did in 2008. Of course, then the headlines came out in praise. Of course, the Fed seems to have halted a potential crisis in the overnight lending markets for now. And that's where we're gonna go next. That's where things really get interesting. So now there's new trouble brewing in the system, which is the final piece that puts us together. Now, before we jump into exactly what that is, let's just look at a couple things. And so the big thing is that the banks don't want to lend. And really, since 2008, since quantitative easing, the Fed has continued to give the banks more reserves, hoping that they'll go create that money into loans. But more and more and more, the banks don't want to lend that money out, especially right now. In this environment, the banks don't want to loan it out because it's too risky. Right? They don't want to risk their money. What if the market crashes? What if the people don't pay us back? So if the banks don't want to loan the money, what is it they know that we don't know? And we can see that the M2 money supply has been growing. So what is the M2 money supply? Let's take a look at that first. So the M2 money supply, there's M1 and there's M2. And basically M2 is the calculation of the money. M2 is a calculation of the money supply. And so it's a measure of the money supply that includes cash, checking, deposits, and easily convertible near money. It's a broader measure of the money supply. So money that's in your checking account, that's money that you're probably gonna spend on your monthly bills. The broader money supply, the cash, the checking, deposits, and stuff, that's a broader money supply. It's money that wouldn't be spent so easily. It's kind of like your savings. M2 is closely watched as an indicator of money supply and future inflation, and as a target of central bank monetary policy. So now that you understand what it is and why it's important, let's take a look at this chart. And we can see here, this is the M2 money stock. This is back to 1985, 1990, the year 2000. And so you can see it just kind of stayed here. It kind of started coming up here as the year 2000. This is the 2008 financial crash right here. It came down, of course. Everybody lost their money. They had to dip into their savings. It started coming back up. I mean, look at this. And then look at this. Does that look normal? When you zoom out, does that look normal? So that's the M2 money supply. And we can see that it's been shrinking lately. So home equity lending stalls out. Remember, loans aren't happening. Banks aren't loaning. New equity loans stall out and the market is shrinking. The home equity debt outstanding in the market continued to fall in the first quarter, declining 13%. The amount of loans have fallen 13%. We can see here, some banks are lending less in this uncertain economy. You feel uncertain about the economy. I feel uncertain about the economy, and I'm studying it like a hawk. The banks, they're tied into the Fed. They know what's coming, and yet they feel it's an uncertain economy. All right, now let's dig into what's going on right now. Now we have something called a reverse repo. So remember, we talked about the repurchase market. So basically it's like a pawn shop. The banks loan money back and forth to each other, and they put up collateral and they agree to buy it back. Well, the reverse repo is kind of the opposite. And it's happening again. We have big trouble brewing. And so a reverse repo is the opposite. It's kind of like a reverse quantitative easing. So in quantitative easing, the Fed is giving money to the banks. So a reverse of that would be the banks are giving money back to the Fed. Now again, I like to take these complex subjects and make them very easy to understand. There's a lot to learn in the in the repo and the reverse repo space. And there's tons of videos that go way more in depth. My good buddy George Gammon, he's gone deep into this. So if you really want to understand how this works, this financial engineered mess of plumbing, go ahead. I would recommend George's videos to learn how that works. I'm trying to make it very easy to understand and tell you what it means. All right. So I'm not going to go super in deep exactly how that works, but we can see here the Fed reverse repo facility sees record 485 billion of overnight demand. Now this is in May, so it's about a month and a half ago. It was at 485 billion, or $500 billion back in May, all right? But let's see how fast it's going from there. Now, to give you a little bit of perspective, again, going back to the charts, we can see this is back here. This is in March of 2020. And so when the entire market was crashing, the banks were like, ooh, we don't want to owe this money to the Fed and lose it. Let's give it back to the Fed. We'll get it back later. And so we can see this reverse repo took off here in March of 2020. And everybody knows what the problem was, right? The entire world locked down. The economy shut down. Well, look at this. What's going on now? Are we in a pandemic? Is the whole world locking back down? Are businesses still open? Why the heck is this going on? What do the banks know that we don't know? Now, again, I don't want to go super deep into how this works. To me, it's not the most important thing. It's what is it telling us is the most important thing. But basically, this tells us, so the commercial bank, this is the JP Morgan, the Chase, Wells Fargo, etc. They normally get money from the central bank. But in a repurchase agreement, basically, they're giving the money back to the bank and they're getting security for it. Like I said, a pawn shop is the best way to explain it. All right, now, why is this happening? And that's the piece that I want to get to, not how this financial plumbing works, because it's really a rat's nest that's way too complex and should never have been allowed in the first place. But why is this happening? Well, it's pretty simple, actually. The banks don't want the money. It's a hot potato, right? They owe the money. The bank owes the money to the Fed, right? They've been giving it to it. It's a liability. And so if they think that it's at risk and they could be on the hook for it, they don't want it. I might as well just give it back when I can. They don't want the counterparty risk. They don't want to risk losing it. It's too much risk. Now, they have the money in the commercial banking system. So JP Morgan, Wells Fargo, they're the commercial banking system and they don't want it. Now, they could do other things with the money. There's lots of other things they could do with the money. They could just go buy the treasuries and actually make more money just buying treasuries, which are basically the most secure asset you can buy because it's backed by the full faith of the government. They could just go buy that and make 3 times as much as they make giving it back to the Fed. Or they could lend it overnight in the repo market, which we talked about in the beginning, and they could make more money that way. So there's things they could do with it that would make them even more money. But instead, they're not doing that. Instead, they're deciding to give it back to the Fed and make way less money doing that. Why? Why would they make less money when they have the chance to make more money? And that comes back to they don't want the risk. They see a lot of risk in the system. Everyone's telling you everything is okay. The banks are doing something with their money different than what we are. Now, it could be the same problem as 2019, which I think it is. It's kind of like a dam, and the dam is starting to break. Right now we have a crack over here, and then we have a crack over here. The dam is still going to break, but the cracks are starting to show up in different things, and that's kind of what I'm seeing. The cracks are showing up in different places. So before the crack was in the repo, now it's the overnight repo, and on and on and on. All right, now what is the danger of this happening? What could happen? If this breaks, I mean, it's the banking system, it's this engineered thing. Why do I even care? Why do you even care? Well, what could happen? Well, the broad money is basically being sucked out of the system, out of the banking system, and it's going back to the Fed. Now, that money could be, should be, would be chasing goods and services. So remember, all prices are always a matter of supply and demand. So if we have the same supply, but we have increased demand, then price goes up. If we have more money chasing the same amount of goods and services, then the price of those goods and services go up, right? But if we have the money sucked out and now we have less money chasing the same goods and services, what happens? Prices go down. So that's it. So we could be, the money, instead of going back to the Fed, it could stay in the market. It could be chasing goods and services. When they're doing this, when they're giving the money back to the banks, it's sucking the liquidity right out of the system. Like in 2008, all the liquidity got sucked up. There was no loans, there was no growth. About $1 trillion has now been sucked out of the system, liquidity sucked out of the system that could be chasing goods and services. And what that means is if the banks don't have any reserves, because they've given it back to the Fed, then what that means is they can't make new loans. They don't have the reserves for that. And that could lead to massive deflation. Again, if no one can get a loan to buy a house, what do you think happens to the house prices? If there's no liquidity to chase goods and services, what do you think happens to goods and services? Remember, supply and demand, the prices come down. Now, to give you a little bit of perspective, we can look at a couple charts here. So this is all the commercial and industrial loans. This is all commercial banks. This is going back to 1950, 1980, 2000. So you can see the amount of loans stayed really, really low. Started right around here. This is when we got off the gold standard. This is the big key piece right here. And you can see that that's when it really started to take off. A little bit of dip here, 2000 dip, 2008 dip, right? We can see those dips, these gray lines are recessions. But look at this growth here. So we've had an enormous amount of growth in commercial and industrial loans, right? The more loans, if I can go buy 10 houses, if you can go buy 10 houses and 3 apartment buildings, how much faster does the economy grow? Versus if there's no loans to go buy houses, right? Now we can see how fast it's growing. Now what I want to bring your attention to is this part right here. As a matter of fact, I've zoomed in on it for you so you can see it a little bit better. And so now look at the loan growth. This is January 2020. And we can see that it went up, new loans, everyone's getting new money, go buy, go buy, buy, buy. And now look, it's fallen off of a cliff. No money is getting out to the system, no new loans are being produced. Now, the thing that you really want to focus on right here is this, the the stimulus going out there. Now, the world has been hooked on QE, on quantitative easing, since 2008. As I showed you that earlier chart, how we could see that once they started QE, the market started going. In 2019, they pulled back on QE a little bit and the markets crashed. The world is hooked on quantitative easing. If they don't continue to give banks money so the banks can keep buying asset prices crash, all right? Now, we're also hooked on on the stimulus. So the Fed puts out monetary stimulus. The government, the Treasury, puts out fiscal stimulus. So they give money to the people. That's your bonuses, that's your unemployment, that's those types of things, the fiscal stimulus. And so just like the assets, the financial markets are addicted, are hooked on quantitative easing, now the fiscal markets, the goods and services are being hooked on the stimulus. All right, I've been talking about this, the Fed put, right? As long as the Fed is gonna keep putting money into the system, asset prices will keep going up. And now we have the government put. As long as the government keeps putting stimulus out in the market, we can see goods and services continue to go up. However, this may or may not continue going on. And that's what we need to be watching for. So what I see is a potential for political gridlock that could affect this. And so what do I mean by that? Well, as soon as the Biden admin took over, they wanted more stimulus than ever before. And next thing you know, there's infrastructure projects and 1.9 and 2.9 and how about 4 trillion? And very quickly, within the first couple of months, we had about $12 trillion they were looking at spending. However, now there's political gridlock. People on both sides, mostly the Republicans, but also some Democrats, are now not in favor of all this stimulus spending. And remember, we're hooked on the stimmy. If the stimmy stops coming, just like when the QE stopped coming, what happens? Prices drop. And so we want to be watching the political gridlock to get an idea of what's happening. And so the question, the debate that continues to rage on is it going to be inflation or deflation? And I would say, well, to get the answer, watch the money supply, right? The more money that gets put out in the system, the more loans that go out there, the more prices will go up. If the money supply dries up, the liquidity dries up, the loans dry up, then we would see deflation. If reverse repo continues, then it shows us more and more signs are happening. But as the reverse repo happens, remember, they're sucking the liquidity out. It's going back to the bank, the central bank. Then that means less money chasing goods and services, which I think could lead to a deflation of asset prices. Now, the one thing to understand when we talk about inflation or deflation is really, it's a nuanced subject, and I've done many videos on this, and I talk about its nuance because it just depends. Now, there's 3 ways to look at this inflation. We can look at the inflation of asset prices. This is your real estate and stocks. We can look at the inflation of goods and services. This is the gasoline at the pump and the price you pay for your steak and your airline ticket. Or we can look at the US dollar versus other currencies. This is like my friend Brent Johnson talks about the dollar milkshake theory. It's the DXY on the chart. We can look at the dollar. So there's 3 ways to look at inflation. Are asset prices going up? Are home prices going up? In Puerto Rico, where I'm at, the prices of real estate in my area have doubled 100% in 6 months. 100% in 6 months. Where I'm from in Southern California, the prices have gone up about 100% in 2 years, so about 50% a year. That's asset prices. Goods and services, gasoline has about doubled in about 6 months. goods and services, steak. And the US dollar is also gaining strength. But there's three ways to look at that inflation or deflation. And understanding that is the key to seeing how this is going to affect you. Now, the question that you probably have in your mind, and you've been waiting until the end, is how to protect your money. All right. So the way that I look at this is it requires a shift in your thinking. And so you want to think about things a little bit different. And you want to think about things in terms of purchasing power and not just the US dollar value. Because as they continue to print more dollars, the value of the dollar drops and it takes more dollars to buy things. And so when you look at the price of your home in US dollars, it looks like it's never been higher. But if I looked at the price of my home in gold or oil or rice or Bitcoin, it's actually gotten really cheap. And so you don't want to look at things just in dollars. Now, the one thing I'd say is you want to have some portfolio insurance. For me, that's gold. I like gold as insurance. If the whole world crashes, even in an inflation or deflationary spiral, I think gold is a great way to protect my investments. The next thing is that you want investments that pay you to own them. I pound the table. I've been pounding the table since I started this channel on having cash flow. You want cash flow because you don't want to live off savings. You want cash flow to pay your expenses so you're out of the rat race. You want speculative growth. You need your money to grow faster than the rate of inflation. Now, if the inflation rate's about 30%, you need to grow your wealth more than 30%, and you do that with speculative assets. And then the other thing is that you want to look at how much of your entire net worth is allocated. Do you have 100% of your money in the markets, or do you have 50% of your money in the markets? I believe that cash is an allocation that should be protected. You want to keep some gunpowder dry, so to speak, so when the markets do crash, you have opportunities to jump into that. Now, if you wanted to figure out more ways to watch this so you can get on it play by play, and of course, not only protect yourself, but come out ahead. Like I said, I am doing a live presentation in just a couple of days. There's a link in the description below. I'm also going to pin it in the first comments. Come join me. I'm going to spend about an hour going deep into these conversations, both inflation and what's happening here. More importantly, like I said, the steps I'm actually doing to protect my wealth and what you could do as well. There's a link down below. Other than that, leave me a comment. Let me know what you think. Do you see these like Wells Fargo is at the tip of the iceberg, and do you see the danger underneath, or do you think this is something that they're just going to paper over? Leave me a comment and let me know. Of course, give me a thumbs up on this video if you like it, and if you don't like the video, I don't know why, because I spent a lot of time working on this, but that's okay. Give me a thumbs down. But either way, leave me a comment and let me know what you think, and that's what I got for you today, all right? To your success. I'm out.